Hey everybody, this is Paul doing a quick dividend video. The market is currently open. It is September 15th. It is 2:30. Market is actually about to close. So I think this is a good time to go over the portfolio, some thoughts, different things that I see going on. So the CPI report came in a little higher than expected. So core inflation is currently at 3.7%. Um, Headline I still believe is at above 4% or so. Um, but the obvious big thing there is oil, obviously. Um, so what's going on with oil? Obviously, Saudi Arabia announced that they were going to extend their cuts. I have my own opinions on that. If you follow me on Twitter, you know my opinions on that. Um, Saudi Arabia's price target is $80. They're easily above 90 right now. It's pretty obvious they're trying to influence just different things around the world and just use oil as a political weapon. That's just some opinions of mine. But how does that affect inflation? Obviously, that feeds through to energy, which was up 10%, which reflected in the report. Um, the good news is the Fed doesn't use that because the Fed can't control that. Anybody who's freaking out about oil and talking about the Fed, I guess they're talking about feed-through effects, but the feed-through effects are very minor. Oil would need to get much, much higher for it to be passed along to consumers the way that it was being passed on previously. And at which point consumers would pull back and switch anyways. Anyways, so what's going on today? Today's just bond market dictating the stock market. So as you can see, 10 years kind of approaching these different areas. We have a lot of things going on with expiration today. Um, and then, the market is just kind of doing what the market's going to do. Um, I think this still basically applies. So as you can see, our Federal Reserve was raised by 500 basis points, and you're hearing news out of like different countries that have raised, the UK specifically, EU, and you're hearing about them in recession almost immediately after they raised. Well, what happened? This is what happened. Previously, we used to be a very adjustable rate society because it would get you a lower rate, but there was also that chance that if somebody raised, you could be affected greatly. Well, these are adjustable rate mortgages these days, and we have 30-year mortgages. That's the big thing. When you go to Canada, when you go to UK, when you go to EU, they're all on 5-year mortgages. So if that 5 years just happens to be coming up whenever they're raising up to 4%, you were previously at like 2 or something, well, your mortgage rate just doubled. Or, and the way it gets passed on, it could be 7% right now. So that's why the EU and UK are immediately feeling these hits from higher mortgage or from higher rates. If you're in the United States, you don't care. I don't know how many times I need to argue with people on Twitter about this, but not everybody lives in an apartment in New York City. A very large amount of people have fixed rate incomes that are not adjustable, as you can see here. Also, good news on the rent front, by the way. So this is what we're waiting on. So annualized rent growth nears negative territory as new supply ramps. So this depends on your part of the country. Before you hit renew on the lease and your manager or your person has given you a hard luck story about homeowners insurance that went up, and that's why they have to up your rent by 20%. Look around, shop around. There are, and if everybody around you is the same price, there you go. Your landlord's quoting you a fair price. But look on every single site before you sign a new lease, because there is a ridiculous amount of supply coming online, and landlords do not have the power that they had. They want you to believe that they still have the same power that they did in 2021 and 2022, but they just don't anymore. So before you sign a new lease, please shop around. That should be the biggest advice to every single person who's renting right now. You're renting. It's not something you should be attached to, It's not going to be your lifetime home. They're going to jack up your rent by 20%, but you find somebody down the street who isn't jacking up their rent by 20%. That's who you move to. And then you tell your landlord that you're moving to that, and I guarantee they won't jack it up by 20% anymore. You know, that's what you got to do. You guys got to, like, renters need to really start exercising some of this real power that they're about to have. They're about to have some very serious power here pretty soon. But if you just renew at the same lease you were at or higher, like, you just gave away your power. So definitely keep looking at that. So let's look at the portfolio. So I kind of pointed this out before on Twitter. I'm like, dividend investing is kind of weird. So if you look at the amount that I have now, 63,457, and then you look at that amount from the beginning of the month, I'm down. So I'm down 817. But if you go to my profits that I've contributed this month, it's 1,500. So in reality, I am currently down. And this is something that dividend investors really never show you, and they should on every video. So 1,500 plus 817. So that's actually how much I'm down this month because of just fluctuating stock prices. And if I wanted to, I could, you can look at my last video and see how much AFB was trading at and SPHD, that kind of thing. But this number right here should kind of give you a general idea right there. So I've been buying the dip. I put a little bit right here in savings, and I've been buying the dip. And the way that you can tell I've been buying the dip is because even though the overall portfolio value went down, the dividend amount, which is the number I have to watch, went up. So $68 more per year in dividends. I did add like a little bit into I think BST, like a tiny bit. I added a little bit into BSTZ, and then mostly I've been adding it into AFB. So you might be asking, why are you adding it into AFB? I'll show you the logic here. Why am I adding it into AFB, which is at 4.15%, versus the money market fund, which is 4.96? And the reason I'm about to show you is very simple. So what everybody keeps saying is, and this is the problem with not having places to store your money for more than a decade, is people forget, yes, it is a risk-free return. That's a word you keep seeing used over and over. What they're not telling you is that at the end of the year, you're going to get something called a 1099 INT, interest form. And you're going to have to claim that interest. So all this risk-free, stuff, that's going to be a separate form that, it's going to be right in your tax center here. And it's going to be a 1099 form for interest specifically. And you're going to have to claim that because your brokerage is going to report that to the IRS. And if it's a large amount, trust me, they're going to want their pound of flesh. And if you don't claim it, then guess what? Then you could risk an audit because your tax record, what forms you submitted didn't match up with what's actually reported to the IRS as income. So you don't want that. So why? What's going on? My tax rate is, so you can just kind of get a general idea of what my tax rate is. So I'm married with kids and whatever, and then a lot of my income is tax free, so I don't have to claim the VA. All of this is tax free. So what you have to do is you have to take my tax rate, for example, which is 12%, and then you have to take this 4.96%, times it by 0.12, and now this is how much gets subtracted off the top of this 4.96 now. So 4.96 minus 0.59, for example. So that's the actual rate. That's federal. Then you have to subtract state off of that because the state is going to want their share of money, and I'm not even sure what Louisiana charges. Louisiana's probably like 8% or something like that, or 7%. So depending on your tax bracket, and I already know I'm already going to owe money to Louisiana because of this right here, the DoorDash income. So that's why I have not just taken every single penny outside of locking in these losses, which I seriously don't want to do. But that's why I haven't taken every single penny and just put it into a money market fund. Some people have done that, but some people are forgetting that you have to claim the interest as income. And that's the big thing that people are forgetting. They're telling you, oh, there's a 5% interest rate. Well, guess what? If you're because if you make more than $89,000 a year and you're married, you're now, instead of 4.96, now you have to claim that much. That's how much just came off the top of that. So 4.96 minus 1.06, 3.9% now. Now that doesn't look too good now all of a sudden, does it? So you have to remember what your tax brackets are. I don't know if this is even worth it or not. Now the reason why I'm putting it at AFB is because every single penny in dividends that this pays out at 4.15% is tax free. It's a municipal bond. That's literally what a municipal bond is, right there. Now, I don't see any dividend investors on YouTube that have even bothered to explain what municipal bonds are. I don't understand why. It's literally free money. The only time that you take a tax penalty is if I sell this for a profit. So if say if I sold all these shares at like 11 or whatever, and this was a positive number, then you take a capital gains tax. That's it. If you've owned it for less than a year. You know, what are municipal bonds? It's pretty easy. I can show you what a municipal bond is. It's very simple. So if you go to municipal bonds, municipals, investment grade is the low yielding stuff. Let's go to this maximum yield stuff here. This is what it is. It's just different. Orange County health facilities, Maricopa County, whatever they're building, development authority, Birmingham Jefferson Civic Authority. These are things that taxpayers and city councils have approved for spending that they need to borrow money for. So you see, Virginia College Building Authority. That's what these are. So that's what you're looking at. So all that fund that I have is basically somebody who does all this for me. They go in here and buy all these different things from all these different states. And you can go to that funds page and there's so many of these different types of things that pay out every month. This just happens to be the one that I like right now. But GYIRX was one that I was in for a long time. Might not even be through here anymore. But there's a bunch of them that I used to be in a lot. The biggest one is this right here. This is the one that everybody trades and actually uses. This one gets treated just like a stock, but you can see it's only at 3% because everybody's piled into it. But then assets 1 billion. Every penny that you get out of this is tax free. So that's just something you need to look into if you're looking for tax-free money. And I just don't see dividend investors talking about that ever. So, currently, my plan is to pile money in the AFB. I'm not doing SPHD right now because not only is it giving me a lower yield that I'm going to get taxed on. Remember, all these different yields, you have to remember you get taxed on all these different yields. So you have to remember what your tax bracket is. So like for example, this is going to end up as qualified income, qualified dividend income. So, you have to subtract off whatever that is. So that's why this is not $45 anymore. It's because this, even with taxes subtracted, is much higher than this with taxes subtracted. This is the math that the people on Wall Street are doing. This is the math that you should be doing. Is what is giving you that. If you want to stay in the market and get your high yield, that's why people are piling into O, or well, they're not really piling in O because it's just a bunch of real estate stuff going on, but it's just the market overall. But O right now is giving you a 5.5% yield at this price, which is ridiculous. It's way higher, and it gets taxed at the exact same way. So I think that's what you need to kind of look into is like how people are like structuring their portfolios. As it stands right now, the plan, nothing's really changed. I want to pile money into here, AFB for example. Definitely put money into the different savings accounts that I have at these different yields. Just to have money ready to go that I can pull out immediately and then put into here if there's like a crash or something like that crazy happens. Like if something breaks in the market. Right now, like a 1%, whatever this is, 1% move in the market, this is not something breaking. This is just the law of big numbers. It just looks like a big thing going on, but in reality it's 0.89%. It's nothing really that big going on. It's barely it's not even a 1% move in the market, In the SPY it's something, it's a 1% move, but it's barely a 1.5% move. So that's what we're currently doing right now. Like I said, I'm riding out this market. The rates just being so high. I believe that once the Fed actually ends the case that they're going to pause and then stop, that's when interesting things start happening in the market. That's when everybody starts saying, okay, well, this is as high as yields are going to get, pile in. Yields are not going to get any higher, pile in to bonds. That's when bonds start to fall like a rock. and that's when the market starts to take off because now all of a sudden your yields are going down, so cost of borrowing goes down. So that's what we're waiting on. We're definitely still waiting on inflation, obviously. It's looking like a January 2024 kind. It's more and more looking like a 2024 kind of thing, because the consumer is just strong. So we still have services that are just strong. I don't see that changing until the job market cracks, which working claims every week tells you that the job market has not cracked. Long-term claims are kind of up, but week-to-week claims are just record low still. So I think that's where we're kind of at. Leave any questions, obviously. Whatever you think. And like I said, the plan is just continue to just effectively dollar cost average into the stocks that I chose, the funds that I have. So thank you. Have a nice day.